If I had to start completely over with my investing portfolio, these are the only 5 ETFs that I'd consider to rebuild long-term wealth from scratch. I'm Dalal. I've been investing for over a decade, and I didn't start with money. I had to figure it out the hard way. I made the mistakes and I paid for them, and I learned what actually works. Everything I share on this channel comes from experience. The growth ETFs that we're covering in this video aren't a one-size-fits-all solution. Think of them as tools that you can layer on top of a solid core portfolio. I would not buy all 5 of these. I choose the ones that fit your risk tolerance and your investing style. If we're starting from zero, then the goal is to give myself the highest probability of success. That's why in this video, I'm not starting with individual stocks like Apple or Nvidia, even though they're incredible businesses. It's because early on, concentration is a risk, not an advantage. An ETF, on the other hand, is an exchange traded fund. It's basically a basket of companies that you can buy with a single investment. When you buy one, you instantly get exposure to dozens, sometimes hundreds of businesses all at once. That diversification is powerful. Instead of betting everything on a single company, you're spreading your investment across a whole group of winners. If one company underperforms, the rest of the basket can keep your portfolio moving forward. Even better, if a company keeps underperforming, the fund replaces it with a stronger one. So the ETF is essentially managing itself for you. Of course, all of that convenience comes with a cost, and that cost is called an expense ratio. An expense ratio is simply an annual fee the fund charges to manage your investment. For the ETFs we're talking about in this video, these fees are extremely low, which makes it ideal for long-term growth. So now let me show you 5 growth ETFs I'd actually buy if I were starting over. We'll walk through their expense ratios, their 1-year performance, and their performance over the last decade. Quick disclaimer, none of this is financial advice. I'm just some guy on YouTube with the mic. So always do your own research before investing. And this video took a ton of work to put together, so if you find any value whatsoever, do me a solid, hit that like button. It helps me more than you know. Okay, so for the first ETF, it's QQQ, the Invesco QQQ Trust. This is the NASDAQ 100 growth engine. If you've spent any time investing in growth ETFs or even looking them up, then you already know or at least have heard of this fund QQQ, which tracks the NASDAQ 100, the 100 largest non-financial companies listed on NASDAQ. Now that non-financial part matters because this means no banks and no insurance companies. And what that does is it naturally tilts the portfolio towards tech, consumer tech, and communications. You're getting Apple, Microsoft, Nvidia, Amazon, Meta, Google, Tesla, Broadcom, Costco, Netflix, basically the backbone of the economy, all inside one ETF. So let's go and look at the numbers. The expense ratio is 0.2%. That's about $20 per year on every $10,000 that you have invested. The 1-year return has been around 24%, and that 10-year annualized return is around 20% per year. That 10-year number is a really good return when you zoom out. So if you invested $10,000 in a decade, that would turn into about $55,000 today. Over that same stretch of time, the S&P 500 averaged roughly 14 to 15%, just to kind of give you an idea of where QQQ lands. So QQQ beat it by 5 or 6 percentage points per year. And that compounding gap becomes massive over time. But QQQ is a growth ETF, so it is some concentrated risk. The top 10 holdings make up a big chunk of that fund. So when Nvidia drops 40%, you're going to see that and feel that. This is not a sleep perfectly every night ETF. It's a growth fund. Volatility is a part of the deal. For me, I like taking on risk because I have more than a 20-year time horizon. One last thing. If you're a long-term holder, look at QQQM. Same exact holdings, but the expense ratio is about 0.15%, and that difference looks small, but over 20-30 years, it really does add up. Next, we have VGT, the Vanguard Information Technology ETF. This is the pure tech ETF. A lot of people assume that VGT is just like QQQ, but tech. Structurally, it's very different. And those differences explain why VGT has actually outperformed QQQ over the last decade. VGT tracks an information technology only index using GICS classifications. That means companies like Amazon are considered consumer discretionary, and Google and Meta are communication services, so they're not included here either. Instead, VGT goes wider inside tech itself. It holds about 425 companies from mega caps like the Apple, Microsoft, Nvidia, all the way down to these mid cap and even small caps that you never see in QQQ. Hardware, software, software, semiconductors, IT services, the entire tech ecosystem. I like that because if one of these smaller cap companies does really well, it will reflect great on the returns that we can make. The numbers: expense ratio is about 0.09%. The 1-year return has been around 21.78%, and the 10-year annualized return is roughly 23% per year. That 10-year return is actually higher than QQQ's without Amazon or Google, so let that sink in. Pure technology has been that dominant, and the fee of $9 per every $10,000 you have invested is basically nothing. The only real caveat: VGT and QQQ overlap heavily on the top. If you already own QQQ or QQQM, adding VGT doesn't really diversify you as much as you might think. But as a standalone position or as a core of that tech heavy side for the growth portfolio, VGT is one of the best ETFs ever created in my opinion. Next we have VUG. This is like the set it and forget it growth ETF. The Vanguard growth ETF. This is something you put in your 401k and you just stop looking at it, and you come back in 30 years. It's not flashy, it's not exciting, it just works. VUG tracks large cap US growth companies based on revenue growth, earnings growth, and forward expectations. You're getting the best growth businesses in America, full stop. And this is where VUG really kind of separates from the QQQ and the VGT. It really captures growth everywhere, not just tech or one exchange. Amazon is here, Google is here, Meta is here, but so are companies like Eli Lilly, Visa, and United Health. Massive growth businesses outside of traditional tech. The numbers: about 0.04% for the expense ratio. The 1-year return is 19%, and the 10-year annualized return is roughly 18% per year. So $4 per year for every $10,000 you have invested. Over 30 years, that difference of the 0.04% fund versus the 0.5% fund can easily mean tens of thousands of dollars that stay into your pocket. So again, expense ratio does matter and has a really good one. Returns are slightly lower than QQQ or VGT, but efficiency here is elite. If you want simple, cheap, and historically excellent, VUG is hard to beat. Then we have SCHG. This is VUG's twin with a small edge. The Schwab US Large Cap Growth ETF. Let's address the obvious. SCHG and VUG are nearly identical. Same fee, almost perfectly correlated, similar long-term returns, but SCHG earns its spot because of just one key difference, and that's about how many different stocks are included and how spread out that exposure is. SCHG holds roughly 250 stocks compared to VUG's 150. That slightly wider net actually helped the performance in certain years. In 2024, SCHG returned 34% versus VUG's 32% on that exact same expense ratio. So the numbers: expense ratio the same, 0.04%. The 1-year return is 17%, and the 10-year return is around 18% per year. Some years SCHG wins, some years VUG wins. Over a decade, it's basically a draw. So here's the honest answer: if you use Schwab, buy SCHG, zero friction. If not, VUG works just as well. Just don't own both. That adds zero diversification and that only creates clutter. Just keeping it honest. Next we have Invesco S&P 500 Momentum ETF, SPMO. The momentum engine most people don't understand. SPMO is different from everything else on this list, and that's exactly why it earns a spot on this list. Most ETFs are static. They own the same companies in roughly the same weights year after year. SPMO is dynamic. It adapts. Every 6 months, SPMO runs a rule-based screen across all 500 stocks in the S&P 500. It's looking for two things: strong price performance over the past 12 months and adjusted for volatility. This isn't just what went up the most. It's what went up the most without being insanely unstable. From that process, it really selects roughly 100 stocks and weights them based on momentum strength. Then it rebalances. 6 months later, it does it again. No opinions, no narratives, no macro guesses, just math. That's why SPMO can look completely different from year to year. And this is why the holdings can feel random, but they're not. Right now, you'll see names like Nvidia, Amazon, Broadcom, Tesla, Costco, Netflix, but then you also see JP Morgan, Chase, Walmart. That sometimes can throw people off. They'll say, why is a bank in my growth ETF? That's because SPMO doesn't care what sector a stock is in. It only cares whether money is flowing into it consistently. If financials are leading, SPMO owns financials. If tech is leading, it'll load up on tech. If consumer staples are starting to trend and move upwards, then it may go there. SPMO's whole advantage comes from momentum. This isn't some theory. It's one of the most studied and reliable patterns in investing. The idea is simple. Money doesn't flow into stocks all at once. Capital moves in waves, and stocks that have been performing performing well tend to keep doing well for longer than most people expect. Momentum exists because of human behavior. Investors chase winners. Money rotates slowly between sectors. Fund managers follow trends to protect their careers. And institutions often have these rules to force them to keep buying what's already working. So SPMO doesn't fight this. It simply follows this trend and takes advantage of it. For the performance in the numbers, the expense ratio is 0.13%. The 1-year return in 2025 was 26 or 27%. That 10-year annualized return is closer to 18%. That long-term number here really matters. Momentum doesn't win every year, but over the full market cycles, it has historically delivered competitive returns with different timing than traditional growth ETFs. So for myself, being honest, SPMO is not a core holding and not a replacement for VUG, SCHG, QQQ, or VGT. It's a satellite position, a rules-based aggressor layered on top of a solid foundation that we already have. When you're investing in growth ETFs, you are looking for more upside, but understand that it comes with more risk versus something like VOO. These growth stocks are excellent options when they sit on top of your solid foundation. Funds like VUG and SCHG can give you a broad exposure to America's best growth companies, while QQQ and VGT add that tech concentration where innovation and earnings power are actually coming from. And then SPMO is that rules-based way to stay aligned with whatever the market is rewarding right now. Most investors lose because they overtrade, overthink, and overreact. This approach does the opposite. It simplifies the process, lowers costs, and lets time do the work. I made a video where I explain the investment pyramid and how I would stack ETFs in a certain order. I also talk about what percentages I would allocate to each layer. If you're interested in that video, watch that next. Thank you so much for watching. Drop a fire emoji if you're still watching now, and leave a comment below. See you in the next one.